The year is 2024. Global markets are in turmoil, banks are failing. It feels like 2008 all over again, but this time, the stakes feel higher. The world watches with bated breath, wondering what will happen next. In times of such profound financial uncertainty, one question looms large: how do we protect our wealth? This essay will explore how the banking crisis of 2024 might impact the value of two very different assets, gold and Bitcoin. The current crisis serves as a stark reminder that traditional financial systems are not infallible. Diversifying your portfolio beyond traditional stocks and bonds is no longer a luxury, but a necessity. Gold and Bitcoin, often touted as safe havens, present intriguing options for investors seeking stability. Understanding their strengths and weaknesses in the face of economic turmoil is crucial for making informed financial decisions. The banking crisis of 2024 is a wake-up call for everyone, regardless of their income level. It compels us to confront the vulnerabilities of our financial systems and seek alternative ways to safeguard our hard-earned wealth. As we delve into the potential impact of this crisis on gold and Bitcoin, we aim to empower you with the knowledge to navigate these turbulent times and make sound financial decisions. To understand the potential impact of the 2024 banking crisis, we need to understand the problems. Globally, banks are grappling with a confluence of challenges. Inflation is soaring, eroding the purchasing power of currencies. Interest rate hikes, implemented to combat inflation, have increased borrowing costs, making it harder for businesses and individuals to repay loans. This perfect storm has created a climate of fear and uncertainty in the financial markets. The collapse of several mid-sized banks in the United States has sent shockwaves throughout the global financial system. These failures, reminiscent of the 2008 crisis, have exposed the fragility of the banking sector and raised concerns about contagion. The interconnectedness of the global financial system means that problems in one region can quickly spread to others, as investors lose confidence and withdraw their money. Adding to the uncertainty is the ongoing war in Ukraine, which has disrupted global supply chains and further fueled inflation. The conflict has also increased geopolitical tensions, making investors wary of holding assets in certain regions. The combination of these factors has created a challenging environment for banks and investors alike, prompting many to seek safer havens for their wealth. For centuries, gold has served as a safe haven asset during times of economic turmoil. Its allure lies in its inherent value, scarcity, and ability to hold its value even when fiat currencies falter. During financial crises, investors often flock to gold as a store of value, driving up its price. The 2008 financial crisis provides a compelling example of gold's resilience. As stock markets crashed and banks teetered on the brink of collapse, the price of gold surged, offering investors a much-needed safe haven. This historical trend suggests that gold could once again emerge as a preferred asset class during the 2024 banking crisis. Several factors support this notion. First, gold is a tangible asset, unlike stocks or bonds, which are simply promises of future payments. This tangibility provides a sense of security during times of uncertainty. Second, gold has a long and established history as a store of value, dating back thousands of years. This historical precedent gives investors confidence that gold will retain its value even in the face of severe economic shocks. Third, gold is a globally recognized asset, easily traded across borders. This liquidity is crucial during crises, as investors seek to quickly move their wealth to safer assets. Given its historical track record and unique characteristics, gold is likely to remain a popular choice for investors seeking to protect their wealth during the 2024 banking crisis. In contrast to gold's long-established history, Bitcoin is a relative newcomer to the world of finance. Created in 2009, Bitcoin is a decentralized digital currency operating on a technology known as blockchain. Unlike traditional currencies, Bitcoin is not controlled by any government or financial institution. This decentralized nature is a major draw for some investors, especially those who distrust traditional financial systems. Bitcoin proponents argue that its limited supply, only 21 million Bitcoins will ever exist, makes it a good hedge against inflation. They also point to its potential to facilitate transactions during times of crisis, when traditional payment systems may be disrupted. The 2020 COVID-19 pandemic offered a glimpse into Bitcoin's potential as a safe haven asset. As governments worldwide implemented lockdowns and economic activity ground to a halt, Bitcoin's price remained relatively stable. This resilience, coupled with its decentralized nature, has led some investors to view Bitcoin as a viable alternative to gold during times of crisis. However, Bitcoin's volatility remains a concern for many investors. Its price can fluctuate wildly in short periods, making it a risky investment for those seeking short-term gains. Despite its volatility, Bitcoin's growing acceptance by institutional investors and its potential as a hedge against inflation make it an asset to watch during the current banking crisis. Don't forget to subscribe to our channel for more insights and updates.